most problems in financial markets ultimately come out of using short-dated capital to do long-dated things.
Welcome. I'm Maneet Ahuja, Editor-At-Large at Forbes and founder of Iconoclast. And we're here at the Case Summit. I'm thrilled to be joined now by Marc Lipschultz, co-founder and co-CEO of Blue Owl, an investment firm with over $284 billion in assets under management. Recently, Marc and his team launched Blue Owl Alternative Credit Fund to provide individual investors with access to the same credit investments that are typically only available to institutional investors. Marc, thank you so much for joining us.
Well, it's a privilege to be here, Maneet, and I never thought I'd be in anything where I was labeled as an iconoclast, so I'm thrilled to be here.
Oh, better than that. You've graced the cover of Forbes, right? So
I'm very lucky.
Yeah, so I think that's an even loftier goal. So, Marc, there's been so much talk about the democratization of alternatives, especially here, but pervasive throughout the industry. From your perspective, what does true democratization look like?
So democratization of alternatives, either could be taken as too, highbrow a term, or exactly right, which is to say it's about broadening access to these products. And let's be a little more colloquial about it. It's sort of private investment strategies that can be a great part of an investment portfolio, as that has been the case for institutions for decades now. I started my career in alternatives. It wasn't called alternatives in 1995 at KKR. And, we had one fund, and of that $1 billion fund, half of it came from basically two institutional investors. So, there's been this long run where institutions have benefited from being able to add to their portfolio better risk return products. And democratization, to our way of thinking, and it was actually one of the founding principles of our firm, was saying, hey, that same experience, that is to say, that same investment experience, needs to be delivered to the individual. And there's a lot that goes into making that happen. But I think democratization is that broadening, sort of putting down the drawbridge and letting individuals be able to get those same privileges.
So take us a little deeper, walk us through. So there's a lot that goes into making that happen. What are some of those things that we need to be watching for as they develop?
So broadening access, democratizing access, I think has a few core attributes. Well, first and foremost, obviously, what any one of us has to deliver is a superior investment experience, right? Bedrock is it's got to be a great risk return result for the investors. That's job one. But then to make that all happen, there's a lot that goes in terms of what I would say is, let's call it structure, and to a degree it's culture. So let me unpack that a little bit. So investors investing in a Blue Owl product, an alternative investment product, there's nothing exciting about, oh, that's great, I have a Blue Owl product, unless it delivers that institutional quality experience and result for the individual. So the first thing is to make sure you design, actually it's your whole firm, as far as I'm concerned, around this idea that individuals are true peers to the institutions. It's not, hey, I'm going to add individuals to this institutional world. It's not oh, that's convenient for the moment, and we're seeing that today. There's a lot of people who are going to dabble around the edges of this, find out they're not set up for it, the investor's experience isn't going to be great, and they'll all retreat again. But those who are committed to staying, it's a commitment to actually saying, I'm going to make sure that they actually get not just access to Blue Owl, access to the very best of Blue Owl. So when we built our firm, we from day one said any investment, for example, any loan we make in direct lending, that same loan goes to the institutional investor and the individual investor access point. So I like to talk about them as access points. So I think part of it is that's a very big commitment actually structurally, and very few firms can or will make that commitment.
So you guys actually only launched a handful of years ago, but your rise and trajectory has been meteoric. Talk to us about how, you were able to grow so quickly at a time when the markets are so unpredictable.
So I consider us very fortunate, and I think maybe ascribing to that notion that good luck or good fortune is something about preparation meeting opportunity. 10 years ago when we created Blue Owl, we saw an opportunity, and it really was at its core this democratization as one principle. But the idea had two elements to it. One was in alternatives. If we look at the 20 years prior to that 10-year ago moment, let's say, what we found was alternatives were mostly about high octane, right? They were about really high returns, pretty high risk. So private equity strategies, which are wonderful strategies, but they're one side of the curve. And really that had been the evolution of the industry. And what we saw was an opportunity to complement that with strategies that are much more, and all of the Blue Owl strategies are about downside protection, about stability, predictability, current income, and inflation
Walk us through
protection.
some of the strategies, including private credit is a big key emphasis for the fund, right?
Yeah, private. So we have three core businesses at Blue Owl, all of which share that set of attributes I just described. So private credit is our largest and probably the easiest to see those attributes in, right? What we do is senior secured loans to big companies that have a lot of earnings, have a big backer, a big equity check. So it's all about making sure that when we make that loan, we're going to get paid back. And it works. We've done well over $100 billion of those types of loans, and our running loss rate, right, has been 13 basis points per year. So it's working. Now, I'm not suggesting, of course, we all appreciate there's risks in the world, but the whole point here is to build a strategy that's durable to those risks. So private credit, easy to probably see. Then within the world of real assets, which is another one of our large businesses, what we do in real assets, which again is a big word, is something very particular. We do real estate that is leased to extremely strong tenants, investment grade tenants, either generalists like an Amazon distribution center or highly specialized tenants, and this is probably the highest growth area within our business and perhaps in all of alternatives, which is the digital infrastructure, where we're actually building and leasing for 15 or 20 years at a time. These pieces of infrastructure to the Microsofts of the world. You can't get a better credit. Quite literally today, it's rated better than the U.S. government. So again, durability, you're seeing the theme emerge here. It's not, there's a lot of ways to participate in real estate, and there have been high octane ways. We came in and said, what is the predictable, stable way? And then we have our GP strategic capital, where we buy equity interest stakes in other alternative asset managers. So we share in the fees they collect. And as you know, the GP business has been a good business. It's a very predictable earnings business. And so we acquire and take our share of cash and return that to investors. So in every case, it's much more about that durability, predictability, not about adding to sort of the volatility. Quite the opposite. It's about making your portfolio less volatile, more predictable, and generating that steady income.
So as a backstrap, at the same time, we're hearing all about this convergence to the private markets, right? For companies that have over $100 million in revenue as compared to the public markets over the last several years. Talk to us a little bit about what you're seeing in that macro environment as there's been this huge shift to the private markets.
So the huge shift, let's start maybe with unpacking why is there a huge shift. So why are private markets growing and the number of companies, for example, in public markets shrinking? Well, first of all, let's start with the diagnosis. The diagnosis is there's something about the durability, predictability, the partnership. We like to call it the 3 Ps, for example, of direct lending. And quite literally it is. That predictability, privacy, and partnership that people value. This idea that to run a business successfully, to create a lot of value, you need to be able to think not day to day, week to week, quarter to quarter, but rather plan for the long term. And public markets, frankly, have gone the other way, right? Public markets trade in nanoseconds now in the world of programmatic trading. And this quarterly rhythm, as even today is being discussed by the administration, is that even healthy? Well, in any case, what we clearly have observed, and we know our business thrives on the idea that we can present someone with a long-term solution. So they can say, where do I want to be in 5 years with this business? So it's not about, where am I today? What happened this quarter? But rather, where am I going? And again, the digital infrastructure is a perfect example. It is pretty clear that when we look over the next 10 years, the transformation of the economy, the digital transformation, and in particular, the artificial intelligence transformation is going to be dramatic. But it's not about tomorrow. It's about being in front of that wave for the next 5 and 10 years. And that's where private solutions are just so well suited. So what we have seen as a result is the burdens of being a public company, the burdens of that tempo of minute to minute, quarter to quarter are a real disadvantage for many companies. So today, as you just observed, 80% of companies with more than $100 million of EBITDA are private. So if you're not participating in private markets, you are missing out on a huge part of the economy. And that is the part that brings us back to this democratization comment we were having before.
Yeah.
Look, obviously it's from a business interest for managers to say, oh, well, we'd like to provide access to other investors. Of course, we're trying to make sure we have access to capital to deliver to the users of our capital. So I'm not suggesting it's selfless.
Right.
That said, when people think, well, what's the motivation here, or what's the benefit to the individual investor? In addition to the superior risk reward, absent participating in private markets, you are missing out on diversification. You are missing out on big swaths of the economy.
And you have a fiduciary responsibility to your investors, right?
Absolutely.
So
we have a very clear
as that
fiduciary
market continues to grow and the public markets shrink, there's almost a risk reversal happening.
Yeah, if you stay in the only public market environment, and listen, public markets are a really critical part of the economy. And the very biggest companies in the world, they're public companies. And so by no measure am I suggesting anything negative about the public market, but rather the combination of public and private is what gives you a whole look at the economy. And it is also true that more and more of that lens requires that you participate on the private side. And we can see it in the public company count as well, right? You go back 20 years, there were probably just about twice as many public companies as there are today. There's something like 4,000 public companies. There were close to double that 20 years ago. So by every metric, the public market is becoming a less significant part and the private market is becoming a more significant part. But it's not one or the other. It's about having a healthy ecosystem. Both are what make, for example, the U.S. capital markets second to none, not even close. The U.S. capital markets thrive because we have depth and vitality in both those marketplaces.
So you have investors all over the world. So tell me, as this backdrop is happening and your business is growing, what are you hearing from clients and investors that are their key priorities right now?
So investors are asking, how do I use privates to get a better result at the end of the day, right? How do I complement my current strategy? Again, this is not about wholesale replacement. It's not that public markets don't play a big role in any portfolio. Public equities have been a really successful strategy. They will continue to be a successful strategy over the long term for people. So it's about adding and complementing to that with things, for example, take our strategies. And again, I'll just use private credit to keep it simple. At the end of the day, we do senior secured loans, as mentioned, and we've been able to deliver results that are hundreds of basis points better than the public liquid alternative, that liquid credit market or that syndicated credit market. We generate returns that are generally have been in excess of high yield, of junk bonds, and yet we're the senior secured lender.
Right,
and
which is safer.
Much safer, and our losses are lower than the comparable public market. We're not saying here, why don't you make this trade? We're saying, how would you like to have a safer portfolio and a better return? Now, again, we appreciate everything has its trade-offs. Some of those trade-offs are about liquidity, and we should be very clear about that. One does not have access to their money every day when you commit to a illiquid or partly liquid strategy. But that trade-off is very additive.
What is the typical duration? You said 5 to 10 years. So for the majority of your products, is that 5 to 10 years?
So our products, we have a range. So no, the loan, a typical loan, for example, we might have a stated maturity of 5 to 7 years. Typical loans probably out for 3 years. But actually, we architect products that depend on the user. Listen, for big institutions, many of the biggest pensions and sovereign wealth funds in the world are investors with us.
Right.
They have no use for access to liquidity. They're managing hundreds of billions of dollars, and they're saying, listen, what I want to do is have a way of investing that for the next 5 to 10 years, you're going to generate these great returns over and over again. For individuals, we've created access points that are much more about having partial liquidity. So we have products in our core income product. We have this now in an interval fund, which is actually one where we have kind of greater access.
That was going to be my next question.
So I'll come on to that as an example.
Interval fund.
Yeah, so this is about liquidity.
Which just launched, right? How is it structured, and how does it feed into Blue Owl's own commitment towards democratizing alts?
So look, we listen to the customer like any business, right? What we have to do is meet our customer where they're at, understand what they're trying to accomplish. And as I said, for some big institutions, liquidity is not meaningful. They're kind of perpetual entities. For individuals, in many cases, some access to capital is very important to them. And so what we've done is create an access point, and the beauty of a product like credit is it actually does have a natural liquidity rhythm to it, right? Because what happens in credit is take our core income product, it has 30 billion of assets, hundreds of loans in it. Well, every loan has a different maturity. Every loan will get paid at a different time.
Right.
So there is an actual natural rhythm to be able to give people capital back at times they ask. We've given capital back from that product every time someone's asked. We've never had to hit the limits on that. They're built to be durable, so you don't get forced into having to get out of loans when you shouldn't. But the key is to have a product where people should never want or need that. And if they want or need it, you meet their needs. And by the way, if you don't meet them in one quarter, then hopefully you meet them the next. The key is to have realistic conversations with investors and make sure, listen, there is a little bit of something here about illiquidity that you ought to acknowledge. But the return you get, the incremental risk-adjusted return, is really compelling. So mix it in prudently. Have a great financial advisor. Do your own work and your own research. All of our jobs are to educate.
Do you think more and more people are starting to see that as a more of a flight to safety option during times of uncertainty? Or do you think that there's still a huge missed opportunity there where investors just aren't, it's not on their radar the way that it should be?
So I love that question, and there's two things can be true at the same time, as they say, right? Which is absolutely, there's a lot of investors have figured out that using the right private products, something like our the products from credit or our real estate, triple net lease real estate products, using those products is actually a flight to safety. Whereas again, back to this earlier point, when alternatives were high octane, that might be considered the risk barriers. High risk. Yeah. Now there's actually the flight to safety, and I'd say maybe the people that are most sophisticated on the topic, most educated on the topic, probably do see that it's actually a flight to safety.
To safety.
That said, there's a large share of the world, and I entirely understand it. We're saying, I know that sounds complicated, it sounds exotic to me, and so by definition, they would just define it as, that must be something riskier. And our job is, I think, to make sure to both put the proof in the pudding and then do a good job as we can educating people about the opportunity.
Yeah. So how do you balance the reward and the risks that come with making alts more accessible, especially for investors who may be not familiar with the private markets right now?
I think the onus is on us as an industry to provide the information, the education, the facts. I'm lucky to be able to talk with you today because you bring to your audience this kind of education. So this is an incredible opportunity as far as I'm concerned. You obviously understand this industry. You have an incredible following, an incredible audience, and a chance to come and just talk about what we do, hopefully in relatively plain language, is part of the job. I understand why people don't understand what we do. And people are busy. It's not their job to go figure out what is the difference between, you mentioned the interval fund. Our interval fund does, for example, one kind of credit, which is so-called asset-backed credit, right? Alternative credit. So it's doing something where we're working in actually much shorter duration, and there's lots of cash being generated, and that's what makes it really good for this interval fund structure. We can come back to that, not to use a lot of technical terms. But in any case, the idea is for us, it's not their job to go figure that out. It's our job to make that information available. So we've tried to do a lot on the Owl's Nest. We have an online set of resources just to explain our products. We just launched a new thing called the Talon, which is about tax efficiency and tax impacts of products. So we're trying to do our best, but nothing's better than a conversation with a thought leader like you.
Oh, thanks, Mark. I'll definitely take that pat on the back.
Well, it's true.
Your fund has grown tremendously, so obviously the industry is seeing the opportunity. But tell us a little bit about how you're continuing to bridge that gap.
Yeah, so investor education, which, by the way, would be the job in any investment business, but especially in this world of alternatives. I don't even like the term because by definition it suggests that it's something different from the mainstream, and that's not what it is.
That's so funny. You are the third person to say that same sentence today.
Really?
That, it's not, in a couple of years from now, it's not even going to be called alternative investments, just investments.
Let me tell you a story that relates to this.
Yeah.
So when I started, as I said, in 1995, I started in private equity. That was not called private equity. Our business was called leverage buyouts. And along the way, people, of course, said they didn't like the name, and in fact, because it implied too much about the financial engineering and less about what we were really, the value proposition, this idea of durability and private capital. And I still remember conversations where we talked about, well, we need a different name. And that led ultimately to private equity as the rebrand for LBOs. So, we've been to this movie a little bit before.
I've been in this industry for a long time, and they call me Wall Street Maneet, and I did not know that.
That is, I can remember being, so to speak, in the room where it happened. It was, I recall Henry Kravis very specifically being, one of the key thinkers behind this topic of how do we help people understand what we do. And so there's an example of the same topic. So then alternatives wasn't a term either, because there were only a few firms, and it was these kind of quote obscure corners of the world. And then of course that changed, and then it became an alternative to publics, and that probably had its day in the sun and was logical.
Right.
Today it's not an alternative. It is a direct complement. It's part of a peer to the public markets. So I don't know, maybe it's privates versus publics. I know we'll have to work together on a new brand name.
We'll work on a new name. That's something journalists are good at.
Yes.
So yeah, we can collaborate.
We would appreciate your advice. But education comes down to, as I said, that we try to present a lot of information online is a beautiful way to be able to communicate. So we try to put a lot of information together so people can be informed. Try, as I said, be with thought leaders in conversations like this. Or look, the event we're at here today at CASE, right? This is an incredible gathering that is all about providing education to these financial advisors, who in turn then can bring that information to their clients. Once again, it's sort of who is supposed to learn what level of of information, and then communicate it to people who have a day job, they have a life, they have other things they need to do, and we have to figure out how to get that information in their hands in the way they want it.
So as we're seeing this explosion and this sea change happening now to the private markets from the public markets, obviously anytime there's new opportunities, the market and regulatory bodies need to react, right? So what would you say are some of the biggest challenges that are hindering this next era of evolution, while, to be fair, simultaneously trying to protect the end user and investor that you're having to kind of juggle or grapple with right now?
Yeah, listen, well-designed and well-placed regulation is a good thing. Right? I mean, we need to have guardrails around many things in the world, and investing's always been one of them. We welcome it. Look, we have been a regulated enterprise for a very long time. When we started our firm, one of the first structures we used is a so-called business development company, which are now very, very prominent, and whether people know it or not, often is the vehicle they're probably investing through as an individual. Almost every one of the continuously offered products, right, these ones you can go in and out of, most of those in credit, for example, are BDCs. So 10 years ago, though, it was not. It was considered, again, a kind of this exotic structure, just like at one time REITs were, at one time MLPs, which I'm sure most audience members will say, oh, of course I'm familiar with those terms. Well, they weren't 20 and 30 years ago. Those were their own obscure structures. But then once investment managers said, wait a minute, I can put really good, high-quality product in that structure and make it even better for access, well, then they evolved and became very prominent. So I think that part of, and as a result of that, is we've been very regulated from the beginning, because business development companies are registered with the SEC.
Right, yes.
So, and again, we welcome that level of transparency. You can know more about our loan book than any bank in America.
That's fascinating.
So any bank in America, every one of our loans is listed every quarter and rated in terms of how we think it's performing. You can see exactly what it's about. And so our transparency is actually much higher. That said, we're not familiar, right? If you said to people, average person, do you know what a business development company is? Correctly, I'm quite sure most would say no. So that's all good. Now, when you get into regulation, then you get into regulating what? And of course, regulating things like transparency, information, appropriateness, all those make a lot of sense. What wouldn't make sense, of course, would be taking private people's capital that has no systematic ties and saying, well, now we want to tell you what to do with it. That hasn't proven very successful. And in fact, for all the times we've had problems in the finance industry, it almost always ends up back with depository institutions, because there's one real core benefit. If you have to simplify it all, that private capital brings that allows us to deliver the stability and that better form of capital for many users, we have long-dated commitments of capital, and we do long-dated things with it. Most problems in financial markets ultimately come out of using short-dated capital to do long-dated things. And there is no more of a mismatch that exists than a bank, because a bank has money that now in an electronic world is 30-second capital, and then when you do 10-year things with it, someday that tends to be a problem, or in any case someone has to backstop it.
That makes
That's
so
the taxpayer.
much sense.
So in our case, we have no backstop.
You've decoded
but
so many financial crises right there that we've seen.
Well, and by the way, it happens, time immemorial. Just think about this. Just go back a couple years. What happened to Silicon Valley Bank? Duration mismatch.
Right.
They had short-term money, did long-term things. In that case, it was even treasuries. It didn't even matter what you did with them.
Right.
But it's mismatched. And so, I think what you don't want is regulators saying, oh, you can make that loan, you can't make that loan. That's
too much
ought to be left to
micromanaging.
Yes, and in fact, it will yield
will
the wrong
hinder,
result.
yeah.
But having guardrails and transparency are a great thing.
Okay. So broadening out a bit, I know we just have a couple minutes left. How do macroeconomic factors like interest rates, inflation, tighter capital markets impact your ability to function and offer your products to customers more broadly?
So part of the job with Blue Owl specifically, so sometimes we can talk, I'll come to the macro. With Blue Owl specifically, our products are designed to be highly durable through a wide range of macroeconomic. When we had Liberation Day, and that had a big shock impact potentially on a lot of companies, actually it had almost no impact on our portfolio.
Wow.
Partly by design, because we try to design portfolios that are very durable to what one would consider, kind of macro variables. Now, nobody's insulated. I'm not suggesting, we bear no relation, to the market. But our job is to do things like software and healthcare services and food and beverage and things that are generally going to be much less volatile. So I can't speak for all, and I wouldn't want to, because private strategies are rangy. But in the world of direct lending and large cap direct lending, and certainly in triple net lease, our job is to say, let's build a strategy where those variables are much less impactful. That's not to say irrelevant, but it is to say much less impactful, because there'll be other parts of people's portfolios that'll be highly sensitive to those variables. And if you want to take a view, for example, on interest rates, there's a lot of ways you can do that through either a public or private structure. What if you say, I don't want to take a view. I want for part of my portfolio to be fully insulated or heavily insulated from interest rates. Well, then you do, for example, our direct lending products that are all floating rate. So if rates go up, well then yes, your returns will go up. If rates come down, your returns will go down. But that's all relative, right? What that actually tells me is it's about delivering incremental reward on top of whatever the market is. So I think it does depend on the strategy that you pick. But I would say that part of our reason to be, and the reason we've been lucky enough to grow the way we have in the last 10 years, is because we've really been one of the leaders in delivering those kinds of more insulated strategies.
I want to quickly talk about one other big piece of news out of Blue Owl. Sorry, not Big Owl.
I think we're Big Blue Owl.
Big. You are Big Blue Owl.
Owl.
That's pretty funny. Maybe you should change your name. No, I'm just kidding. That's your $15 billion data center. Talk to us a little bit about that partnership and why that was a priority for the business right now.
One big, beautiful blue owl. Isn't that
I
think it's resonant,
good.
isn't that?
I can
seem to remember one big, beautiful something recently.
Yeah.
So, yes, the data centers. So this is a really, really interesting area for capital investment. And that is this digital infrastructure that's going to underpin the continued transformation, AI, and just cloud in general in the economy. And we're talking about quantums of capital they're really like unheard of. And almost you become numb when you kind of talk about these numbers. But within the world of digital infrastructure, we have the leading position in being the capital partner of choice to the very biggest hyperscalers, because we have both the capital, the ability to arrange the portions that we don't ourselves continue to own, and importantly, we have a 1,000-person operations group inside of our digital infrastructure business that can design, build, and deliver on time these incredibly important assets to the big hyperscalers of the world. So it takes all that to get to the answer, but then you have to get to the scale. So in Abilene, Texas, where we are together with the fantastic developer, in that case, Crusoe, teaming up. We have wonderful partnerships with other people in this industry to deliver for Oracle what at the time started was the biggest data center project in America. And we'll see the path it takes, but we've already since now done one called the Borderplex in New Mexico that actually is as big, maybe bigger, and there's been a lot of chatter about projects even bigger than that. But let's just stay with that one. $15 billion in the current phases just to build the physical data center buildings, the power, the cooling, and the scale. I want to bring this to life for people.
Yeah,
the scale,
help us understand how this scale compares to other similar projects.
So I was there 2 weeks ago. I've been lucky enough to be around a lot of big infrastructure projects. One of the things I did when I was at KKR was help start the infrastructure business many, many years ago. So I've been around a lot of projects by serving on the board of Hess Oil. So I've seen a lot of this. And this project is orders of magnitude, kind of, to me, more mind-bending. So first of all, picture that the property this data center is being built on is the size of Central Park. That's what we're talking about. And then we're talking about 4 million square feet, all being constructed in a matter of a couple of few years. And this is not generic square feet. This is fully powered, fully cooled, where it can literally hold tens of thousands, each building, tens of thousands of GPUs, right? Those NVIDIA chips. And so we're talking about $15 billion to build it. Inside those buildings will be $40 billion of chips or so. So let's just consider that this one project is going to be a $50+ billion capital undertaking. We'll have completed it in a matter of a few years, which is unheard of.
Unheard of.
And it will use, just again, give scale to it. The amount of power that we will have both on site and through connection to the grid. And by the way, in this case, West Texas, access to grid resources, renewable resources, actually from Western Texas, wind. So take that all together. The power this data center consumes is comparable to the city of Denver.
Wow.
City of Denver.
Just incredible.
And as I just said, we just signed up to do the same thing in New Mexico, and there'll be more of these projects to come. And we're lucky because we have those partnerships.
So I know we're out of time. I want to briefly ask, because we touched on AI, how are you implementing AI into Blue Owl overall as an organization?
So AI plays a few different roles for us. So we just talked about, obviously, the investment opportunity set, and I will say, with 30 years at least of experience, I have not seen a better risk-reward opportunity than digital infrastructure. I think it's safe to say nobody's going to be wrong on the idea that we are going through a decade-long transformation. Now, the winners and losers on the application layer, that's a different conversation, and there'll be sophisticated people you'll talk to about that. Different risk return, different proposition. Inside of Blue Owl, we have a couple different things. So we, of course, have ourselves adopted the use of large language models, trained them on, for example, our investment memos, our portfolio memos, so we can quickly access information about our portfolio. You mentioned before, like the macro environment. When something happens, we can now in an instant find out where exposures could lie. It might have taken us, as it did, I can harken back even 2 years, to Silicon Valley Bank, and it took us a weekend to figure out. No, weekend wasn't bad. That's pretty good to know all our exposures, but it took a weekend of human labor to sort that out. Now it's an LLM that's been trained. We just announced about a week ago a partnership with Harvey. As you know, Harvey is one of the kind of better known of the application layers. And we've formed a strategic partnership where we're going to help them develop the product applied to alternative assets. So we'll be the beneficiary of delivering that to our clients. We'll be an early adopter and user, so that benefits our investors. And Harvey will, of course, benefit from actually being able to bring their overall platform into very specialized capabilities.
That's fantastic. So what we like to do on Iconoclast is also get some leadership lessons. And so you mentioned that you've been in the industry for over 30 years. What's been the most surprising leadership lesson you've learned since now running Blue Owl?
So I'm going to start with answering the most surprising with the least surprising, which is the least surprising is that it's all about the people and all about the culture. So, of course, you have to have the strategy. And of course, you have to have all the capabilities. But if you don't have the people and the culture, that will not end up being enduring. So, what's the most surprising? I guess you could say it's the other side of that, which is, listen, the hottest idea, the best idea, the hottest shot in the investment business, that's fleeting. That is not what true long-term investing is about in the land of privates. It's about being able to build a really predictable infrastructure. And that's what we've also had the benefit of doing at Blue Owl, which is being able to start with a clean sheet of paper 10 years ago and say, this isn't about an individual. It's not about me. It's not about Doug Ostrover. It's not about the other senior executives in our firm. It's about the whole firm being a durable partner and meeting investors where they are. So I guess maybe the most surprising is that in the world of investment, it's not about trying to find the latest hot shot.
It's not about the biggest, newest win.
No, it's about finding people that are, and this is the way I tend to think about it, skating to where the puck is going. We love that Wayne Gretzky, skate to where the puck is going, not to where it's been. And I think the biggest takeaway is leadership is about people that are looking over that horizon and then are going to really develop a culture, an inclusive culture, an empowering culture, and together go down that track. To me, it's all about that.
Well, Marc, thank you so much for joining us.
Thank you. What a treat to be here. I really appreciate it.
It's great.